Okay, let's get started. Be respectful of those who are on time and let the others join as they come. Um, my name is Scott Bartle, and I'm with In Maricopa. And thank you all for being with us this morning. Our presenters are Jim Chaston and Chris Scoggin. And Jim is one of the pioneers of Maricopa 2.0. He's been around the block here. I got to know Jim in the early 2000s here in Maricopa, and he's was the first one to plant his flag in the ground to be a CPA and accounting firm in Maricopa. And I say that, although I don't know, back in the Wild Wild West, Jim, there could have been an accountant
That's true.
we don't know about, but be that as it may, we'll still call you the first. So Jim,
Certainly in the incorporated days of Maricopa.
yes, for sure. And then a year ago, Chris Scoggin joined Jim's team. And so they are partners in the business now. And Jim's been a CPA for a couple dozen years, like Jim has. So they've got, I think, 55 some years of experience as CPAs under their belt, or collective belt. And then they've also, you'll start to see that Chaston Tax and Accounting is going away as the gentleman decided to rebrand, and they are now a CSCPA group. And so thank you both for being with us this morning and sharing your expertise. Would like, if you guys don't mind, just Carolyn and Jean, if you wouldn't mind introducing yourselves and tell us about a little bit about your business, that'd be terrific. Can't hear you, Carolyn. You're gonna have to do it in sign language. Guilted into a video. Sorry about that.
Peer pressure.
Well, let's start with you, Jane.
Okay, sorry, I'm just joining a couple minutes late. I heard the end of Scott's introduction there. So is it the five of us on the call?
Yes.
Okay. Well, I'm a client of CSCPA Group, a happy client. So I'm just here to learn more. My business is a medical practice, small 6-employee group in Scottsdale.
Good to see you, Jane.
Good to see you, Chris. Hi, Jim.
Hi, good to see you.
And then, so why don't I start? I'm going to go ahead and share my screen here and just get started.
Yeah, and on the side streets, there is no fence.
Andrew, welcome. If you don't mind muting, that would be terrific.
Okay, so as we had just mentioned, we have changed the name of our firm, and it does reflect that we are continuing to grow. So CS stands for Chaston Scoggin, Jim's last name, my last name. So it's the same great people that you've been working with. We just have updated and refreshed the name, to reflect that we are continuing to grow and we're continuing to bring in expertise. Jim certainly has been a leader in the community and continues to work in the practice. I'm hoping I bring somewhat of a different perspective, or at least a different set of experience to the firm. And between the two of us, we speak literally on a daily basis on what's going on, what's happening with our clients, obviously within the bounds of confidentiality. But what I believe that sets us up is we're the largest, most knowledgeable CPA firm in Maricopa. And, our goal is to continue to grow and really be the best option, the most knowledgeable option for all of Central Arizona. Our primary focus is small to medium-sized businesses and their owners. We would define small to medium-sized businesses as primarily businesses with less than 25 employees. That is our specialty. We, even to get a little bit finer point on it, we love to work with people that are starting their business, are starting to enjoy some success, and helping them grow from being a sole proprietorship through either moving to a partnership or an S corporation, getting them set up to succeed financially, do it with paying the least taxes possible, but paying the right taxes, ensuring that they're staying compliant with all applicable laws, both local and federal. And then our real specialty is then applying some relatively complex financial and tax strategies to their business. Once they have achieved the point where they are trying to legally and properly shelter as much income as they can, pay as little tax as possible, that's really where we enjoy working. So our topics for today, IRS tax code changes and updates. We want to kind of walk you through some of the updates. This will be primarily business. We'll get into a little bit of the individual because we cannot separate our business clients from themselves. In other words, all of our business owners do need to file tax returns. And so we do not look at a business separately and apart from the business owner. Jim's going to give us an update on PPP loan forgiveness. The real big tax act of 2020 was the CARES Act, which did, as part of that was the PPP loan provisions, but there were other provisions within that act. We're going to give you some ideas of what the IRS is going to be focusing on in 2021. And then the last thing, and probably what everybody here is for, is the tips and tricks, the 10 pieces of advice that we want to give out. And there are some pretty good ones in there this year. So with that said, I'm going to jump into the IRS tax code changes and updates. So for the changes and updates, there are a couple of things that companies or employees of companies that have been affected by COVID-19 can take advantage of. In particular, if you've had employees that were either diagnosed or had families that were diagnosed with COVID-19, and you continued to pay them for their sick leave, you can recover these through the employment taxes, employment tax credits. Another big change that came through on the CARES Act was the qualified improvement property depreciation. We'll get into this in more depth, but what we're basically pointing to here, and to give you a little primer, if you've made any improvements to business real estate, this could be a significant tax planning change that could free up, particularly if you've had a bad year this year, could free up some prior year tax credits, or I should say taxes paid. One change that has not been published, if you choose to, higher education programs that are offered to employees can now be used to pay student loan interest. Another interesting change has been that the IRS now considers healthcare sharing ministries. I think we've all heard ads for those. I think a big one is called MediShare. They are now considered health insurance. This is more of a change on the personal side, that if you do participate in a healthcare sharing ministry, you can now take this deduction as the same way that you would deduct health insurance costs.
And Chris, the one additional item to that is if a self-employed individual is using the healthcare sharing ministries, that can be considered self-employed health insurance and get that deduction above the line also.
Correct. Yeah, great point, Jim. Thank you for doing that. This is not going to be a change that shatters anybody's world, but the business mileage deduction went from 58 cents for 2019 to 57.5 cents for 2020. I hope that half a cent difference isn't going to ruin anybody's Christmas. And then for net operating loss carrybacks. This was also a provision in the CARES Act. And basically what this said, and we'll cover this in a little bit more detail, although this does get probably more complex than we want to get into on this presentation, is that if you have had a net operating loss for 2018, 2019, or 2020, the tax law was that you could only use those in future periods. That law has been changed with the CARES Act, and now you could go back and apply that to previous profitable years and then recapture the taxes paid in those years. So that's a quick summary of some of the tax code changes. As I said, most of these emanated out of the CARES Act. But with that, the biggest provision of the CARES Act was the PPP loan program. And so I'm going to turn it over to Jim and let him kind of just give you a little refresher. I know we've been talking about this all year, but Jim, if you would, please take it away.
All right. So just to kind of gauge where people are at, who has PPP loans out there? No, Carolyn, no. Yeah, Jane does. Okay, so just a real refresher on the PPP loan. It was designed, and it's probably on the next page. So,
right.
So now go back. I'll get to there. So there's 3 forms, and this is for the loan forgiveness, depending on the amount that your loan is or what you spent the money on. So the 3508S is if your PPP loan was less than 50,000, you can use that short form. If you spent all of your funds on payroll and you didn't have a change or a reduction in staff, then you can use the 3508EZ. And if you don't qualify for those, then you use the full 3508. So what they tried to make easy, now they've created 3 different forms, and you got to figure out which form. So simplification at the federal government level. And then go back.
I'm sorry.
Yeah, and so primarily, it's based on payroll. Those of you that were on earlier, we certainly recommended that you use the entire amount for payroll if at all possible. And then we did talk about non-payroll, which, rent, utilities, some lease payments and so forth that could be used on. Although I think because of the extension from 8 weeks to 24 weeks, pretty much everybody can use all of the funds for payroll, which makes the whole process significantly easier. And then, yeah, go ahead to the next page. Well, I guess the last thing on that previous page was, and we'll get to it, is the non-deductibility of covered expenses, meaning if you use the PPP loan funds for the qualified purpose, then you're not able to deduct those. And I'll talk more about those in just a few minutes. Next page. Thanks, Chris. And the big thing is if the PPP loan is used for the specified purposes, it can be forgiven. The latest rules in the PPP is that you can, a minimum of 60% can be for payroll, and then up to 40% for the remaining qualified purposes. It did change from 8 to 24 weeks. If you got your PPP loan on the front end, so prior to June, then you had a covered period of 8 weeks. However, you could change that and elect to 24 weeks if you wanted to, so that you could spend all of the funds. Or if you got your PPP loan after June, then it was automatically 24 weeks to spend all of the allowable funds. And the main reason for the PPP loan was to minimize layoffs, minimize business shutdowns due to the COVID related restrictions, and illnesses that may have affected the business. Next page. Yeah, and again, I talked a little bit about this, the 3580S, the EZ and the full. And so the big additional item to that is the required documentation of all of those. And so, you know, if it's all spent on payroll, then you're just going to need payroll ledgers, bank statements proving that you actually paid the payroll, and so forth. The documentation can get to be quite a bit. So I know that what I submitted was easily 90 pages when I submitted mine. So it can turn into a lot of pages. Next page. Payroll cost calculation. I'm not going to get into a huge amount of this. However, with the business owners, because that's who we focus on, the maximum amount of salary that a business owner can have is still based on the 8-week period, the original amount, which at a maximum, it's 8 weeks of what their salary is for the previous year at a maximum of $100,000, which that works out to be $20,833 if the owner is being paid at $100,000 or more. And then for a non-owner, it is still $100,000. However, it's based on 24 weeks. So if that employee is making $100,000 or more, then the maximum amount that can be applied to this is the $46,154. Now, keep in mind, if they're only making $50,000, then it's still 8 or 24 weeks of $50,000. And then, so the employer paid health insurance premiums are part of that. It includes retirement plan contributions, except for the owners. And then the state and local taxes, such as unemployment taxes, are part of that. And they're for the periods. So let's say it's for the amounts that are paid or incurred. And so if you didn't get the PPP loan until May and you paid a bunch of taxes in May, yet they were for April, those do not count. However, with the 24-week period, everybody should be able to use just payroll for that. And if that is not the case, you can certainly talk to us separately. Next page. And again, I'm really not going to talk about this because pretty much everybody should be able to use the payroll, which makes the whole forgiveness process much easier. However, these are the items that you can use it for: rent, mortgage, the interest portion of your payment, utilities, and some leases that were in place prior to February 15th. Next page. Yeah, so dates and timing. Again, the covered period, it begins when the loan is funded and up to 24 weeks. Then at the end of that covered period, you've got 10 months to apply for forgiveness after the covered period. So here's an example. Let's say you got your PPP loan on May 16th, May 15th or 16th. You've got 24 weeks, which gets you to the end of October. Then you've got 10 weeks to apply for that forgiveness, which is the end of August 2021, in order to apply for that forgiveness. The lender, so you're going to apply for that through the lender that gave you the loan. It is just guaranteed by the SBA. The loan is actually through the bank. So you've got 60 days after the application is received by the bank that they have a chance to review it, and then they submit it to the SBA. The SBA then has 90 days to determine if the loan is forgivable, and they communicate that forgiveness to the lender, and the SBA also pays the bank off at that within that 90-day period of time to satisfy the loan. And then the lender then notifies you that it is forgiven, or what portion is not forgiven. And the biggest thing that we're going to see here is a lot of people were applied for both the economic impact disaster loan grant, the EIDL grant, that was up to $10,000. And while that is not taxable income, the maximum amount of forgiveness is still based on the amount of the PPP loan. So if you got a PPP loan for $50,000 and you got an EIDL grant advance of $5,000, then only $45,000 of your PPP loan is going to be forgiven, and you're going to need to repay that $5,000 because you got $50,000 from the PPP loan, you got $5,000 from the EIDL grant, so you receive $55,000, and only $50,000 of that is forgivable. And so there's $5,000 that is left to be repaid. However, because of the way that they wrote the law, it's not the EIDL grant that is forgiven, it's the PPP loan that is forgiven. And so you'll need to repay that within 5 years at whatever the 1% interest rate or whatever that interest rate is, credible rates. So, and then the PPP loan forgiveness tax implications. So the IRS, a week before Thanksgiving, came out with some additional guidance just a couple weeks ago in IRS Notice 2020-32. And basically what the IRS has said is, yes, the PPP loan forgiveness is not taxable income. However, the funds that were used to pay for payroll expenses, well, those funds were not derived by your income, by your business. They were given to you, and they were essentially not paid by you, and so those are not deductible. Basically backdoor taxable. They're taxable through the back door. So that $50,000 of payroll that you spent your PPP loan on, those are not deductible. Because those were spent, those funds were spent in 2020, then this PPP loan is taxable in 2020, regardless of when it's forgiven, whether it's forgiven in 2020 or 2021. The expenses are not deductible in 2020. There is provision in there, however, if a portion of your PPP loan is not forgiven, then the funds that were used from the unforgiven portion of your PPP loan, meaning it's loan and you have to pay it back, those are still deductible. There is a new form and attachments that will need to go on to your 2020 tax return when it is filed for any amount of the PPP loan that you want to claim that you do not want to pick up as income. And you've got to attach documentation and schedule it out. The biggest thing we're going to see is people that got both the EIDL grant and the PPP loan. There's going to need to be schedules and attachments that need to go with that tax return to show that a portion of that PPP loan is not forgiven and therefore you can deduct it. It's just going to, a lot more work on next year's tax return and to track that all out. Because the IRS is going to assume if you got a PPP loan, it's taxable this coming year. And you got to prove that it's not if it's not. Next page.
Jim, if somebody has not received or applied for a PPP loan, can they still do that?
Yeah, it's taxable unless and until you have proof that it's not going to be forgiven. So it's not about the income. It's about the expenses.
Tax implication aside, for folks who may not have gone through the process last summer or late spring to get a loan, my understanding is there's still federal funds available for the PPP program. Could someone apply today for a PPP loan?
No,
No.
that ended on August 8th
Yep, the program's closed.
or August 6th. The program is closed. Regardless if there's still money out there, it closed on August 6th. And so, and that is how the IRS is getting around the issue of the loan forgiveness issue. Normally, a loan forgiveness is not taxable until it is forgiven. However, what the IRS is saying is, no, the loan in the act of Congress, by definition, the loan forgiveness is not taxable. The issue is the expenditures that you use the PPP loan funds for, as long as if you use them for payroll, then it is presumed that you use them for qualifying purpose and that you will apply for forgiveness, and therefore those expenditures are not deductible. And that is the IRS's position. And if you want to claim that those expenses are deductible, you've got to prove it to us. And that's what that IRS notice says is those expenses are not deductible. And if you want to make them deductible, you got to prove it to us by saying that PPP loan is not going to be forgiven, or you didn't spend it on the appropriate purposes, and so it's going to have to be repaid and it's still debt. Then there's still it's still deductible. But that is the approach that the IRS is currently taking, is that it's the expenses that are not deductible, not that the PPP loan forgiveness is taxable income. You know, it's simple. In my view, it's very similar. There's some technical rationale behind it. However, it goes back to the whole insurance mandate, that is it a fine or is it a tax? And we had to go to the Supreme Court for them to say it's a tax. Anyway, it's semantics. However, there is some technical information behind that. And bottom line, PPP loan is taxable in 2020. Next page.
Okay. Jim, thank you for that.
Back to you. Yeah.
So a few of the other, obviously PPP was the number one issue that we've had with our business clients for 2020, and has created a lot of confusion. I apologize if what we just went through seems like you've heard it 10 times, but it still remains the number one question that we get. There were a few other interesting CARES Act provisions that could benefit our business clients. The first one is the employer-sponsored higher education programs. The higher education programs that are set up, and these are set up to assist your employees with paying for things like colleges or continuing education. These funds, which are tax deductible for the business, but are not considered taxable income to the recipient or the student, these funds can now be used for student loan interest. Certainly, this is something that we would want to verify is appropriate, but let's say that you had a child that worked in your company and that adult child did have student loans. This may be a way that you could help your child with paying for that student loan interest. Now, obviously, this needs to be offered to all employees, and you cannot pick and choose which ones. But on the flip side of this, if you do not have a child or a family member working in the business, you can also say, no, we're not going to reimburse people for student loan interest. But it's an interesting tax planning tool that can be customized very carefully to use in the business. Another one that people have kind of forgotten about was the reimbursable COVID-related sick leave. And what this said is that if one of your employees or one of their family members was diagnosed with COVID or reasonably suspected that they had been exposed to COVID, if you continue to pay them while they were off, not working, up to 10 days, you could pay them, continue to pay them your salary, and through the payroll tax credit. So when you file your quarterly 941s, you could apply to get a 100% refund of the funds paid to somebody for sick leave if it was related to a COVID sickness. And then the 50% credit for employee retention. And the way that this is practically applied is if your business was closed down due to a government mandate, or if you had more than a 50% decline in your business income, but you continued to pay your employees while they were furloughed, or just to ensure that they were going to be available to you when your business came back, there is a credit that you can apply for 50% of the wages paid while your business was shut down due to a government order, or while you were suffering more than a 50% decline in revenue. We certainly can help you with getting more specific on any of those deductions or provisions.
Hey, and Chris, just one added point to that 50% credit there is if you use the PPP loan funds to do that, you can't double dip. So
Correct.
you can't claim the 50% credit while you're using the PPP loan money. However, because the PPP loan was extended to 24 weeks, I think there's some unique planning that you can use the PPP loan for a later period of time and still qualify for this. And so I think there's some unique planning if you fall into that situation that could be done.
Great point, Jim. Thank you for clarifying that. Wanted to get into what the IRS has communicated are going to be some of the areas of focus for them for coming up in 2021. This first point, the independent contractor versus employee, I put this up there because every year they say this is a focus of theirs. I believe it has been a top focus of theirs for the last 20 years. What this issue basically boils down to is sometimes when you are paying somebody that is working for you, there is a very fine line between when that person is an independent contractor, somebody that sets their own schedules, uses their own resources and tools in conducting the business or the work that they perform for you, versus an employee. The reason that this is a big focus and the IRS does very much want you to classify these people as employees is they want you paying the employment tax, Social Security and Medicare on behalf of the employee. An independent contractor needs to pay both sides of self-employment tax, whereas an employee only has to pay half of that. I put that up there because they mention it, but again, as I said, that has seemingly been a focus for the last 20 years. One that is really becoming much more important is the virtual currency. And again, as I had said earlier, these tips or these areas of focus will both span business and individual tax issues. And this is one that does just that. Most businesses I know do not accept Bitcoin or other virtual currency for payment. What those types of they have become considered investments, or as the IRS refers to them, stores of value. So because they are considered investment, they treat them much like they would if you were buying and selling stocks or precious metals. And what they want you to be doing is reporting your purchases and sales, particularly when you sell, and whether you've had a gain or loss on the sale of that virtual currency. I can tell you that they have gone after some of the larger virtual currency wallets, Coinbase in particular, and have subpoenaed their records and have contacted over 13,000 clients of Coinbase that have purchased or sold over $20,000 in virtual currency. That was for tax year 2018. They're going to continue to get more aggressive. And if you are invested in virtual currency, even if you think that it is not traceable and it is completely offshore, I can almost assure you in the next several years, if you continue to do that, you are going to get a letter from the IRS wanting you to report that. And with that, on the 1040 tax return this year, that there is a question right at the top of the form, right under the name and address, that asks you if you bought or sold any virtual currency. If you check that box, no, and then they go back and subpoena records and come back, they could, I'm not saying they will, but they could accuse you of tax fraud. I mentioned that just because it is becoming that big of an issue.
Well, it is tax fraud.
It is tax fraud. You know,
That's the issue.
I didn't want to falsely accuse anybody. The last thing that really the IRS has shared with us as licensed preparers and licensed to represent clients in front of the IRS is that they are going to be increasing their business audits. I put up here are the latest information that we have on businesses getting audited. If your business is doing under $100,000 of revenue or gross sales per year, you have a very low likelihood of getting audited, less than 1%. But it does jump for the $100,000 to $200,000 businesses. They are focused on that in 2018, and they are telling us they are going to be even more focused going forward for the tax year 2020, the tax returns we're about to prepare. Over 200,000, then it drops to just slightly under 2%. The point we're making is that even though business audits have become, and tax audits have become seemingly less intrusive in the last decade or so, the IRS is starting to realize that they do need to have a presence out there, and they do need to be selecting businesses for audit. The other thing that has happened is they've become much more sophisticated in who they select for audit. They are using data metrics and data analytics to become much more precise on who they're going to audit. And when they do audit, they're much more precise in specifically what they're looking for. So we just want to put that out there, not to scare anybody, but really just to say, have your records in good shape. Be ready to prove the expenses that you claim on your business tax returns.
Hey, Chris,
Yes.
and I apologize to everybody. I hadn't seen those numbers yet. I assume these are for Schedule C business returns and not partnership and corporations.
These are actually, Jim, and this came out of the seminar that we were adjusting yesterday. These are all businesses. According to that, and I'll share the statistics with you, but that
Perfect.
was this was for S corps, everything except for C corps. This does not include C corps, but this is S corps, partnerships, and sole proprietors.
Okay. So it just kind of, for Schedule Cs, those numbers are actually down from prior years. So, you know, self-employed Schedule C with your personal return, those statistics are actually down. However, for partnerships and S corporations, those numbers are way up as a reference point for everybody.
Okay. Now we come to what you actually have really come to listen to, and these are the ones that I want to go through here. Some of these I know are very much common sense. However, it helps us to just remind you as you're going, and I know that as business owners, you guys are very busy. But I want you to think about, did you have a good year? Did you have a bad year? Jim and I can tell you that our clients are split about 50-50. Some of them have had the best years in business that they have ever had. Some of them have been completely devastated. by COVID and all of the restrictions around COVID. So we're kind of having a bifurcation in some of the advice we're giving. Some of our clients are coming to us and say, how do I shelter some of this income? How do I take steps to minimize the tax hit that I'm going to take when I file these returns in March? Others are, what can I do to recapture some of the taxes I've paid in previous years? Because, you know, I need to find some money to put into my business so that I can survive into 2021. So the first four are really, if you've had a good year and you're trying to minimize your taxable income and minimize the taxes paid. And these make the assumption that you're filing on a cash basis. If it's an accrual basis, there's less knobs that you can turn. But if you are a cash basis taxpayer, one of the things you may want to do is prepare and send your customer invoices in January. That way you can be assured that those invoices will be paid in January, and you will not have constructive receipt, we call it, of the money in December and need to claim that on your December tax returns. Prepay your expenses in December. And I guess I'm probably not talking about paying 6 months worth of rent, but let's make sure that you get your rent check. If you are paying for leased property, get your rent check out on December 31st, or even better, December 26th, just to ensure that your landlord receives that and you can take that as a tax deductible expense.
And yet I will tell some clients to prepay 6 months of rent.
There you go. I don't always take that aggressive of a stance, but technically it is a cash expense if you're a cash basis taxpayer. Other things, if you're thinking about making a big equipment purchase or making improvements to your offices or to, you know, a piece of business equipment, consider ordering and paying for that equipment in December. Again, take that as a tax deductible expense. And even if it's a piece of equipment that typically we would set up for depreciation over 5 or 7 years, we can take that as bonus depreciation or Section 179 equipment and accelerate all of that expense into the 2020 tax year. And then the last tip that we're giving you to help you shelter 2020 income from taxation is to set up a retirement plan for yourself or a retirement plan for yourself and your employees. You can set up a simple IRA plan and be able to put $13,500 into that, and that will reduce your taxable income. Of course, that makes the assumption that you have $13,500 sitting in your bank account that you don't need to use for other business purposes.
And just a real kind of follow up on what Chris has said of prepaying expenses. So you can prepay up to 12 months worth of expenses and write them off when paid for everybody that's cash basis, which, I mean, unless there's a specific reason, anybody that has less than 25 million of gross revenue should be cash basis, in my opinion, unless they're in a unique situation. So why I really like this is, and while I may not say pay 6 months worth of rent, I may say pay 3 months worth of rent, pay 3 months of utilities, you know, buy some inventory, because then in January, February, and the first week of March, so basically in 2 months and a week, you're going to recover all of that cash back because you don't have to pay that in January, February, and March. And so your bank balance very quickly gets back to where it was. And yet you get to write off all of those expenses and save the taxes that you're going to have to pay on April 15th. So, you know, I just had a client that I talked to who's going to prepay you know, $40,000 worth of expenses in the first 2 months and a week, and it's going to save him $11,000 in taxes by April 15th. And so just by, putting 40,000, think of it as an investment. I'm going to invest $40,000 into a stock. I'm going to sell it in 2 months in a week, and I'm going to get $51,000 back. As far as an annualized return, that's 120%. You're not going to find that in very many places. Now, yes, you've got to have the cash to be able to do that. And we're just pushing the taxes out into a year that maybe, we don't make as much. And so that's kind of the name of the game with prepaying expenses. And I much prefer that. The biggest thing that just drives me nuts, and this is a huge pet peeve of me, and I get why the auto industry does it, because they're trying to sell vehicles, is, oh, I got to go buy a new truck so I can save taxes. That's a horrible financial decision unless you need a truck.
Mhm.
So don't go buy something to get a 25% tax write-off when you don't need it. Taxes are the tail of the dog, and so don't let the tail wag your dog. You want the dog, which is your business. Yes, taxes are a part of it. However, don't run your business on saving taxes. Run your business to make money and to be profitable. And then we can deal with tax issues around that and to minimize taxes. However, yeah, I think you get what I'm saying there.
Absolutely. And Jim, you stole my metaphor. Don't let the tax tail wag the financial dog.
Yeah.
And we do, as CPAs, we do get presented with that quite frequently. Somebody comes in and says, "Didn't I make a great tax move? I went out and bought a $80,000 truck." And we look at them and say, "Well, what was wrong with the 10-year-old truck that you were using?"
Or the 2-year-old
Nothing.
truck you were using.
Yeah, right. Nothing. But I saved $20,000 in taxes, and we said, "No, you spent $80,000 for that new truck." So neither here nor there. We won't beat that, to use your metaphor, beat that dog anymore. Number 5 is, if you've had a difficult 2020 and you are looking to, you feel as if, or you sense that you are going to recover as hopefully, knock on wood, and the vaccines become widely distributed and this pandemic does start to recede, you feel like you're going to get back to profitability in 2021, you may want to delay. Again, if you're a cash basis taxpayer, you may want to delay paying some of these. Not that you can't use that tax loss in future years. However, to the extent that you can move it to next year, that may be a better situation. In particular, when I say to do the reverse of 1 through 4, I'm really talking about number 3. Put off that new purchase, new equipment purchase until potentially later in 2021, and then take that tax deduction in 2021. So that's through number 5. And there's a reason why number 6 and number 7 are twice the size of any of our other tips. These are the ones that really, we think, can move the needle. And you need to sit down and talk to your CPA on whether you want to do these. But the CARES Act does allow you to take 2020 losses, if you did lose money this year, and apply those backwards. This used to be a tax planning tool that we could use, and it was taken away from us in the 2017 Tax Cut and Jobs Act. They said at that point the net operating losses, or NOLs, can only be carried forward to future years. With the CARES Act, they have reversed that now and said, okay, we're going to allow you to go back up to 5 years, or actually not up to, go back 5 years, period, stop. You have to start 5 years ago, and then come forward and apply those net operating losses. And what that could do, if you paid significant taxes in 2015, 16, or 17, you may be able to recapture that, apply those losses, wipe out that taxable income, and then achieve a refund of those taxes paid in previous years. I know for our businesses that have suffered, getting any type of cash infusion would be beneficial to them. Number 7, this is QIP is qualified improvement property. And this is a new tax rule. Improvements to real estate, business real estate, have been all over the board. Some of these had 5-year depreciation rules. Some of these had 39-year depreciation rules around them. With the CARES Act, they have consolidated and said any improvement that you've made to the inside of a commercial property, whether you own or you lease it, and this is an improvement that you would typically capitalize. It is now set up as QIP property and subject to a 15-year depreciation. That, of course, doesn't move the needle. But what that QIP is also available for is that you can take an accelerated depreciation or essentially write the entire amount off in the current tax year. You can also apply this to 2018, 2019 tax years. So if you did make improvements to rental or owned real estate in those years, you can now go back and amend those returns, take that entire deduction for the improvements you made to commercial property, and then reduce your taxable income for 2018 and 2019. Now, I want a big asterisk or caveat here for both number 6 and number 7. It means you are amending prior year tax returns. Sometimes we feel, again, I hate to keep beating this metaphor, but sometimes it's better to let a sleeping dog lie. But we want to throw that out there because if we do have clients that are desperately looking for sources of cash, this may be a strategy we want to utilize. Then for 8, 9, and 10, for number 8, this is one that is really basic, tackling and blocking, but you would be amazed at how many people just forget because they get busy. Calculate and pay your estimated taxes by January 15th. That's going to keep you from paying a non-payment or late payment penalty when you do file your taxes. Number 9 and number 10, I will freely admit we are being self-serving here, but get your financials closed and get your financials over to your CPA as soon as possible. If you can get them to a CPA, not necessarily us, by January 15th, first of all, they're going to be able to really pay more attention to ensuring that your business is properly and fully tax advantaged. We do have customers that come rushing their financials through our doors on March 9th, hoping to meet the March 15th filing deadline. And frankly, I'll be perfectly honest, we're pretty busy then, and we're probably going to tell them that they need to file an extension. So get your financials over to your CPA as early as possible.
Yeah, not probably. The extension will probably already be filed.
Yeah, you're absolutely right. I'm being more than kind.
You're being nice.
We'll tell them, well, we filed your extension a week ago, and we'll take a look at this right around April 17th. And then the last thing is, the one piece of advice: if you interview and hire a CPA that can become familiar with your business and ready to answer your questions before you need to make these critical business decisions. Both Jim and I have many, many decades of experience of somebody coming in and saying, whether it's on the individual side or on the business side, hey, by the way, I bought this piece of property, or I sold this piece of property, or I invested in this business, or I invested in this piece of equipment. That if we could have just had a 30-minute conversation with them before they took that action, we could have saved them tens of thousands, or in one particular case I had last year, hundreds of thousands of dollars in taxes. Unfortunately, they came to us after the decision and after the transaction had already been made. And there's not a lot we can do to unring that bell once it's been rung. So those are the 10 business tips and tricks that I wanted to go through. Any one of these, we're more than happy to have a conversation with you regarding these. And then the last slide I have is again, we're CSCPA Group, Chaston and Scoggin. We're here in Maricopa, where we have been for 16 years, going on 17 years, Jim.
Next month, 17 years.
And please feel free to pick up a phone and give us a call. We're always happy to chat.
Thanks, everybody.
And let's see.
We've
I'm going through the messages that we've got. And Carolyn, I've got a question here. I had an IRS notice this year saying that a contractor used the wrong social security number.
So yeah, let me take that one because
Sure, please do.
there's a couple of different things about that. So your obligation in this situation is to get a copy of the card and have them actually fill out a new W-9. And I don't know if they had a DBA that they were using or if it was just their personal name. That's typically where I see that, is if they have a DBA and you put that as the first name on it, you're going to get that notice. And so what has to happen is you have to put their personal name with the DBA underneath them, and the social security number is the issue with the 1099. If it is correct, if everything then if it is correct, that is your obligation. Your obligation is filled by that, and I think Schedule B or whatever it is on that document is you have to get a copy of the document and a new W-9 and continue the way you are. That's your obligation.
Jim, and I can add to that just because I've gone through a very big audit on this. You have to make that request twice of the contractor. If the contractor, and I understand that the social security card that they've given you was correct, reply back to the IRS, and you just need to respond back to the IRS that you have done this. You have attempted to correct the error, although there is no error, twice. And that really, that ends your liability for trying to get in the IRS's eyes, the proper social security number. So once you have done that, made that request twice to get a corrected W-9, or if they fill out a W-9 and it's the same as the one you have no further liability after that. So, okay, well, with that, guys, I will stop sharing my screen. Please do feel free to give us a call if you have any questions, and we appreciate you attending the meeting.
Thank you very much, guys. Greatly appreciate the great content.
You bet. Thanks for everybody that came.